Hi, and welcome to our talk. I'm going to start today with the homepage of Yahoo Finance. Yahoo Finance is one of the best places for news if you're interested in researching stocks. Big news today is the jobs report. The jobs report was better than expected. Shows a very strong, improving economy. Um, so we had some manufacturing. The economy was in constant, this strong cycle. So looking forward, it doesn't look, you can see this really 10-year goes up. But let's look at the comparison. Okay, yeah. So we with this, if this jumps so much, usually the stock market usually goes down, but it didn't today. Um, so let's look because of the 10-year Treasury going up in yield. We expect all of the sectors revolving around interest rates that are interest rate sensitive to be affected. So let's predict what's going up and down in the sectors today. Um, so home builders, they sell less homes when there's higher mortgage rates. We have banks actually do better whenever interest rates are lower. So we expect banks to do bad today. Um, any company that has to borrow money will be taking a hit today because interest rates, are going up. Let's look at the sectors ETFs. We do see the home construction ETF going down, home builders, because the demand for housing goes down as interest rates goes up. Um, real estate ETF. Okay, those are all the same sectors. Real estate, utilities. If there's a risk-free return that's high, then people are not going to reach for yield at for the utilities. So that all makes sense. Healthcare, there's a high dividend paying types of stocks. So we expect the healthcare sector to go down too. Let's look at the ones going up the most. Um, S&P retail ETF stocks are doing good. Um, metals, mining. Okay, so let's see. Recently. So it's gone up 1.74% today. So any oil stock is going to do good whenever the price of oil goes up or the oil companies are going up. Also, our theory has been as the economy improves, there's a more demand for oil. So so whenever the global economy improves, when there's stimulus being given to Chinese companies, that means there's more demand for oil in the biggest oil user in the world, which is China. So that helps. And then we have Mideast crisis where there's countries attacking each other in um, oil producing countries. So we combine all that, and it looks like the price of oil is going higher. And as a contrary investor, you have to think in terms of this is a sector that's been out of favor for years, 2 years maybe. And all of a sudden we have a catalyst. The catalyst is higher oil prices, and we have Mideast conflict. We have the global economy improving. So a couple major catalysts to make the stock prices of oil companies go up. So let's look at some of our talking points. Let's look at Yahoo Finance homepage. We can see there's a big deal about today's job report. Okay, we already talked about that. Um, so the job report can be good and bad. If it's good, um, and there's a lot of people getting jobs and less people filing for unemployment, that means the Fed will have to not raise interest rates, but lower interest rates less. Okay, look at this. It's good to understand how to avoid. We're going to look at the industry. Like they make a lot of money from baggage fees and things like that, but in general, there's a lot of competition, and for some reason, they don't turn much of a profit. A lot of them are in debt. A lot of these companies are in debt. So let's look at um, the fundamentals for Spirit Airlines. Hold on. Okay, sorry about that. Okay, so we can see that um, we have some red flags here. Number one, the PE ratio is 33. That's pretty high. Um, we see that profit margins negative, negative return on equity negative 59. Okay, so those are our first red flags. Let's look at some more red flags. Total debt 7 billion with 1 billion cash. So we have around a $6.5 billion debt, and the market cap of the company is 245 million. So those are some red flags. Let's look at some more information. Let's look at the earnings of Sprint Airlines. You can see there's a lot of negative reported earnings, and the forecast or more negative earnings for the next couple years. So we know to stay away from companies like this. Let's look at another company that might be going bankrupt. Okay, Walgreens Boot Alliance. We have a very, very similar situation with Walgreens. They have a negative $6.74 earnings per share. So they're losing money. Let's look at their earnings. Okay, well, their stock price obviously is going down. Their earnings are projected to be flat. So it's not something that you can really invest in. Um, it's not going to be growing. So we know that much. Let's look at the, okay, that was interesting. Yes, X out of that. Let's go back to my talking points. Okay. Okay, this is worth it. Okay, so our talking points are today is beginning of October. October, we expected, some we were still overbought right now on the stock market. So if we look at our stochastics on our S&P, we're overbought. We're kind of going down right now. We're at a 75. So this isn't the time to buy. You want to buy whenever we're at the bottom of this range and whenever the stochastics are low, like this happened, when this happened right here and right here. And so we're halfway between our trend lines, and we're in the middle of nowhere right now. Um, okay, the big news for this week was we had a dock workers calling off a strike on the East Coast. Um, that would have been a major catastrophe for the economy in the United States. It could have really made the stock market go down a lot if we had to shut down the economy. That would basically shut down the economy. So um, we might have that again. They have a temporary hold on that strike until January 15th to work out the details. So maybe January 15th we'll have the same issue come up. We don't know. Right. So okay, so the talking points are S&P's down 1% for the week. 74% of the stocks above the 200-day moving average. Agreed in the stock market. Um, okay, earnings season is basically over, but we're going to be starting the earnings announcement season again. So if we look back at our timeline, we can see next week the earnings start again for the third quarter. So hold on. Okay, so we have the banks starting out the earnings next week. We have JP Morgan, Bank of America. We'll go over some more of the upcoming earnings reports. We'll go over them right now. Hold on. Okay, here are the list. So Friday, JP Morgan, Wells Fargo. That tells us a little bit how the consumer is doing. And so far, the consumer is doing well. We know the unemployment situation is good, so the economy is doing good. So we're not going to really go into a recession. That's the biggest fear of most investors in the stock market, that there's going to be a recession. Okay, so we're going to get Citigroup. Okay, all these tell us how the consumer is doing. So we'll hear from those leaders how they're doing. Um, we have CSX coming on Wednesday. That tells us how the economy is doing in general with freight loads for the trains. We have TSMC. They are manufacturer of semiconductors for majority of companies that are big in America. We have Tesla earnings on October 14th. We have American Express, Visa, and MasterCard. They'll tell us how the consumer is doing. So there's all these hints that we have to read the tea leaves to really know how the consumer is doing. And when the earnings come out, that tells us a little bit more about the strength of the economy. If the economy isn't good and there's too many hints that we're going to be slowing in the economy, that means that there's going to be a recession and the stock market goes down 10 to 15. Okay, so and we have Coca-Cola, we have Alphabet. These are big tech earnings coming this week. So these are very important because they're leaders of the market right now, the uh, Magnificent Seven. So uh, we have UPS, their big report, and Amazon. UPS tells us how the freight traffic is doing. That's a big hint on the economy. And Amazon, of course, is the biggest retailer. They'll tell us what the consumers like. All right, so we got that over with. Now let's go back and look at what else we have to look forward to here in our um, okay, we have okay, the earnings this last week of October are going to be tech earnings. So that is why I have this green. A lot of times, good earnings reports catapults the stock market up. So, and October is traditionally a good month. So we see from right here, it's one of the better months. This seasonality didn't work out in September, actually. September was actually a really good month. It ended up being up 1.5%. So everyone on the news basically on TV were saying, September is a seasonally bad month. It's a bad month. Um, it doesn't always work out that way though. It just happens to be these summer doldrums and there's no earnings reports really for the most part of September. So um, it didn't work out this time, but for the most part, it's been working out pretty good. Let's look at what else. Okay. Okay, so we have the 10-year Treasury going up a lot today. So that's going to affect a lot of the interest rate sensitive companies. Um, we have this little bit of pickup. You can see we have like a little trend and it's breaking the trend now. So right now the trend is going up. We have a little uptrend in the Treasury. Um, okay, let's see what else we can see. Um, the price of oil is up 10% since last week. That is a pretty big uh, jump, and that's probably because all the fighting going on in the Mid East. Okay, so and on top of that, we had China stimulus. Last week we were saying um, the demand for oil goes up when the world's biggest market is stimulated. So if there's a lot of money being given to companies in China, there's a higher price of oil usually. So that could be why. So this could be the time to start looking for oil stocks. We're going to go over an oil stock later on today. But oil stocks have been like one of the worst performing sectors this year and for the past couple years, actually. So this goes back to our theory from the beginning of the year, the worst to first. This could be where the oil starts catching a bid. Uh, you see, inflation hasn't changed. It's around 2.5%. The dollar index is up a little bit, but it's still on a downward trajectory. And gold is up 1%. Um, let's look at the greed index, where the investor world is greedy right now. And you see, whenever the investor world is greedy, take some profits off the table and don't buy, or just don't buy. All right, so let's look at the amateur investors are still greedy. That matches CNN's greedy. And the VIX is now 18, which is it's kind of low still. So there's not a whole lot of fear in the market. Hold on. Okay. So because we're greedy, we're probably right here in our emotional chart. So emotional chart is people get really excited and about the stock market, and whenever the things are crashing, people don't want to buy. And you want to do the opposite as an investor. When people are greedy, you want to start selling or don't buy. And when people are fearful, capitulating, that's the time you want to buy. And hold on for a second. Okay. So some of the things that could lead to a crash, we don't have a whole lot of these things right now that we have to worry about. Um, right now, the biggest unknown for the stock market is the election. If there's an election where where all the Democrats are on one side or all the Republicans are on one side, that could cause major issues with the stock market because there would be rules, there'd be um, bills passed that could really affect the stock market. Right now, the stock market roots for an equal House and Senate so that there's no bills passed because that raises the certainty in the stock market. The stock market hates uncertainty. Um, right now, the AI stock bubble doesn't seem like it's going to be bursting anytime soon. NVIDIA came out with um, a statement this week, we'll go over later, that said the demand for their new chips are insane. So that means that that means that their earnings are going to be good. So we have these little hints here and there that whether earnings are going to be good or not, and we have to look at the news every day to determine that. And let me see. What on? All right. So so it doesn't look like the economy is slowing down in recession. We had a good jobs report today, and we had good services sector report, ISM services sector report. So those are any recession risks are off the table right now. So that's really good. Um, all right. So let's look at some more. Okay, the worst to first. XLU, the utility sector, is now the leading sector in the stock market with the IT and communication services. That's the first time this year that that's happened. So, um, and primarily it's happening because of the AI theme, where AI data centers are building out, and uh, they need to help. They need utility companies to make more energy, basically. And you can see our worst at first. The energy sector is the worst performing sector so far this year, only up 11%. But we have catalysts for the energy sector now where the global economy is doing good. The US economy is doing good. China's stimulus is helping a Chinese company use more oil. So the demand for oil is going up, and we have a wars in the Mideast where most oil companies are. If Iran is bombed where their oil is manufactured, like the pipelines, then the price of oil will go like up $20 a barrel, which is will help this sector. All right, so let me see. Losers of last year will be winners of this year. We've been saying since the beginning of the year, and that's actually coming true, actually. Um, but the winners of last year are still winners of this year. So I was wrong about that. All right. So let's look at some of the, we already talked about the sectors. Let's look at some of the um, stocks going up and down today. Hold on for a second. All right, we see what is the theme with these? We have a lot of credit card companies up today, a lot. And why would that be? I don't know, because earnings don't come out for 2 weeks for a lot of these. So, uh, okay, we have Capital One, we have Discover, Synchrony Financial. They're all credit card processing companies. And we have some material companies, Albemarle, they make um, lithium. They mine lithium. We have AIG. What other companies going up today? Okay. Let's look at the ones going down today. Hold on for a second. Okay, the ones going down to the most today, Equifax, Lennar, these are all interest rate sensitive stocks. Home builders go down because the price of the 10-year treasury is going up a lot. So we have all these extra space storage, they're all related to interest rates. American Tower. Okay. Um, we have Mohawk Industries. I think they make carpet and stuff like that for houses. They make things for houses. So all the housing plays are sensitive to interest rates. That's why they're going down. NVR is a home builder too. All right, so that makes sense. Let's look at the ones going up and down in the NASDAQ. We see, hold on. Okay, we see a lot of energy companies. These are electricity producing companies going down. So utilities. We have we have Supermicro. We have some semiconductor companies. The Qualcomm, Supermicro. Okay, so we have utilities going down, maybe because that's the interest rates going up so much. And we have AMD going up a lot, and these are all related to the data center. So AMD makes chips for the data center. We have MongoDB. They make software for a data center. Zscaler, they provide cybersecurity for data centers. Datadog makes software for data centers. And okay, so we have that theme right now. All right, so that was a good exercise. Let's go back to our talking points. All right, let's look at Dan Dow's picks for the beginning of the year. Um, we've been very patient with this. We've been following it, and KWeb went up 30% in the past week or two. So this KWeb is the Chinese tech ETF. And we'll go over Dan Dow's comments about this later on. He basically predicted this from the beginning of the year. And Dan Dow's theme from the beginning of the year was this this has been out of favor for 3 years, and it's about time for it to be back in favor again. And but we didn't have a catalyst. We didn't have anything to make the stocks go up. And that changed with this Chinese stimulus that happened last week. All right, so and we see Amazon's up 19%. Meta is up 65% this year. Texas Instruments up 21%, and XBI, the uh, small cap biotech ETF is up 10%. So Dan Niles has done really good. I can't wait for his next year's picks. All right, so if you look at the 10-year chart, 5-year chart on KWeb, you can see it's down like an incredible amount. Like even after the run up in the past week or two, it's down like 70 or 80% since the all-time highs. And that was basically because the Chinese government started imposing rules on them. They started fining the companies and they made it really hard to have a reliable set of rules to follow for companies. And all of a sudden they provided this stimulus. So that caused that part of the those stocks to go up. Okay, so we already talked about the upcoming earnings season. All right. Okay. Hold on for 1 second. Okay. You can see the energy sector has been in a downtrend since last April. And only this week did we see it break out of this downtrend. So you can see that's very important. And most likely, other stocks will be following this in that sector. Um, you can see that we might be starting an uptrend. We did the same thing with utilities at the beginning of this year. And we have a couple catalysts for this energy sector. We have the AI build out. There's going to be more demand for oil and gas for the power stations. And we have the Middle East crisis, and we have the China stimulus. So we have a lot of catalysts for this sector. So let's watch that sector go up, or see if it goes up or not. Okay. So let's look at other charts that are interesting. Altria, you can see that um, it's down at the bottom of its trend line, and we have it's oversold. So it's almost the perfect time to buy that if you're interested in buying that. Look at the next one. Um, Amazon. Okay, Amazon is oversold. It had a good set of news today about the port strike, and they're not going to strike. So that could be a catalyst for the stock to go from an oversold to an overbought situation. Uh, Procter& Gamble is another example of it's kind of a dividend stock, and it's at the low end of its stock trend lines. Okay. Okay, next. Okay, next we're gonna see what Dan Niles was saying. Here's a here's a link to a video of him on YouTube. He basically said, "Don't fight the Fed and don't fight the uh, Chinese government, their Fed." And he said monetary fiscal policy has driven stocks up in the United States, and the same thing for China. China's valuations at the beginning of the year were incredibly low. All you need is one thing to go right to get them going. So he had that prediction for KWeb to go up way at the beginning of the year. So he said Chinese tech stocks are selling for 10 to 20 PE ratio versus 30 for the US mega caps. So that's a really big difference in valuation. The big problem is reliability. So we don't know what rules China is going to have on their companies that will affect their profitability. Okay, let's look at another video from Jensen Huang from NVIDIA. He said the demand for Blackwell chip is insane. He said Blackwell manufacturing is on schedule. So when you're investing in stocks, you get crumbs of uh, ideas of how the earnings are going to be going in the next quarter. And you have to pay attention to everything the CEO and related companies are saying about their their products and and what they're doing. He basically gave us the hint that they're going to have a blowout report in the next earnings season. And the stock went up 3% on the news. So you don't really buy on that news and the 3% if it's going up. You have to, for every stock you're following, you got to have in the back of your mind the company CEO said that there's an insatiable demand for his best selling, his most profitable product. And whenever the stock goes down 20%, which it will, you have to like remember that and say, hey, I remember whenever he was saying it's going to be a great earnings report next time, that's when you buy it. So you can't really buy it whenever everyone else is buying it. So for every one of the stocks we're following, we have this mental note of what people said and things that could affect the earnings report. Um, so we know now that Nvidia is going to be doing well, and we're going to wait for it to drop. And then whatever everyone's selling, we'll say, well, it's time to get some. All right. So hold on. Okay. There's an article on these three bargain bin dividends value stocks that become too cheap to ignore. Sometimes I think they're just making these things up. They haven't really done a whole lot of research. I've researched one of these stocks just to see if it had any credence. Okay, let's look at Honeywell. Honeywell seems like it's going in an uptrend. They're a manufacturer of equipment for um, aerospace and uh, large manufacturing things. All right, so they're in an uptrend. Looks like they're doing pretty good. This is one of Jim Cramer's favorite stocks. He talks about it all the time on his show. Let's look at some of the fundamentals. Market cap is 131, so they're decently sized companies for a large cap. Their forward PE is 18, and according to Yahoo Finance, they're 1.69 PEG ratio. So Yahoo thinks they're 1.69 times, 1.6 times overvalued. Um, Profit margin are decent at 15%. The return on equity is 32, so those both are really good. And they have 29 billion out of, so one fourth of their market cap is in debt. What we see 29, so 20 billion in debt out of 131. So that's not that bad. That's reasonable. And their dividend is 2%. That's what we got from this. So they're a decent company, but how well, let's look at their earnings estimates going forward. They're growing at 11 around 11% if you average out the years. And that's pretty consistent. So that's really good. But I would, so they're 1.6 times overvalued. That's exactly what Yahoo Finance came up with. So if they're 11 PE and they're growing, their PE ratio is at 18, they're growing at 11, then they're 1.6 times overvalued. So let's take this price of $200, which they're trading at now, divide it by 1.65, and that gives you the price of 122, which is the price I would buy it at. I wouldn't buy it right now at 202. That's like pretty expensive. And they're only growing at 10%, so it's not that great of a company for growth. They have a 2.3% dividend, which is a 13% return, which is okay. It's just not great. Um, All right, so let's look at a stock screen I did. I do this every week. Every once in a while, I do a different sort. Most of the time, it's by market cap because those are more reliable. The bigger companies are more reliable. This week we did a sort by peg ratio to look at see if we have any really cheap stocks out there. Hold on for 1 second. Okay, okay. So I picked out two. stocks that look like they're bargain basement stocks. We have Noble and Coinbase. First of all, we'll look at Coinbase to do just a sanity check. Coinbase. We can see just by looking at their earnings estimates, they're projected to go down. So this is not a growth stock. It's not, they're selling at a really cheap valuation for a reason. And it could be their industry is being disrupted. Um, Maybe it's because the Coinbase, they basically allow trading for crypto assets. They um they might be being disrupted because there's ETFs now that allow you to trade the same Bitcoin and Ether without having to actually own them. So that's a major uh, problem for this company. Okay, plus there's regulation problems where there's potential regulation and enforcement that could cause them to follow rules. And I don't know, it's pretty iffy. I wouldn't be investing in this. And look at all this negative earnings for the past couple months, quarters. So that's inconsistency. So I wouldn't be interested in this one. Let's look at the next one on our list. This is Noble Corporation. Hold on. Okay, they do offshore drilling. So it's a very specialized form of drilling for oil. And they have they kind of a niche in this. And right now they've been in a downtrend with the price of oil, but you can see based on our XLE, let's look at our XLE chart. It kind of mirrors the XLE. Here it is right here. You can see the XLE has been going down with this Noble price. And my guess is if we continue to see the price of oil go up and we see the XLE continue an uptrend, we're gonna see like a breakout in stocks like this. And so for the chart and for the industry, it's a two good sides. Let's look at the statistics on the earnings estimates. You can see, hold on for a second. Okay, you can see from the earnings estimates, this is an amazing. I don't know if this is real or not. They're set to grow their earnings. They're double their earnings from last year to this year, and from this year to the next year, they're going to go up 46%. So 69% growth from year to year, from last year to this year, and this year to next year, it's 46% growth. One problem is we don't have a lot of earnings, people following the stock to really get a good feeling in their stomach that this is they're going to continue this growth past next year. Hold on. Okay, so based on their current if they're growing at 60%, their PE ratio is 6 currently. So they have a zero point 0.1 peg ratios that are 10 times undervalued if that's true. But I don't know if we can rely on this. It seems pretty too good to be true. But well, I have to research it, I guess, a little more to really think, is that real or not? If it's real, then it's 10 times undervalued. Uh, so the contrary investor will say oil is the lowest performing ETF this year and last year. All oil stocks are down now. There's catalysts for oil. Many tensions. We have price of oil. We have Chinese stimulus, and a growing economy in America. So, okay, sorry about that. So, let me review that again. Okay, so we have 40% growth, 46% growth from this year to the next year. We have catalysts for the oil industry to go up. So, this is one we'll watch. Um, okay, so let me see what else we have to see here. Let's look at, okay, let's look at a list of the most held stocks by hedge funds. All right, so we have Microsoft, Amazon, Alphabet, Apple. Why would the hedge funds have these as a top holdings? Because over time, they're the most reliable, and you can buy and hold these stocks without turning them over and have a decent return. And that's probably why. And most of the mutual funds we are following are holding these same investments. So it's always good whenever you're invested in a stock. It's always good to have a second confirmation that really smart people like hedge funds are buying the same stock that you do. Okay, so there's a list from there's a list from Morningstar of some of the most undervalued stocks. I did some research on these just to see. We see Honeywell is the one that we got from the other articles. We have a double confirmation that Honeywell is a good quality stock, and Morningstar thinks that they're undervalued. Let's look at Apache, just one of the ones at the top here, just for kicks. Apache has, well, first of all, they have declining earnings, which uh, their earnings projections aren't great. So we don't want to even touch a stock that has earnings that are projected to go down every year for the next 5 years. So that's bad, and they're missing their earnings estimates. Uh, let's say 40% of the time. So those two combinations, looking at this chart, we don't even want to touch that stock. Um, so let's look at some more stocks that are undervalued. We see a lot of energy companies in here. We have Duke Energy. We have uh, what other kind of stocks? We look at this one. It's an oil company. These SLB, it's called now. They do oil drilling also. So we have a lot of oil drillers that could be undervalued. And ExxonMobil, you see a lot of oil companies. So whenever you see a lot of similar companies in the same sector undervalued, sometimes it's good to start concentrating on that sector as a potential new sector that could be undervalued that you can invest in for a long term. I happened to buy ExxonMobil in the year 2020, whenever there was a pandemic and there was a low demand for oil. And that's an example of buying stocks when they're out of favor. And right now, these oil stocks are out of favor again. Okay, so let's look at, all right, all right. I think that's okay. That's all yeah, that's all I had to say for today. Well, I hope you had a really good session today. Hope you have good investing next week. And if I can answer any questions for you, let me know. And uh, that's about it. All right, take care, everybody.